Hello everyone, welcome back to our corporate action series. This is part 3 and today we are diving into an exciting topic, stock split. If you missed the previous part, be sure to check them out. Now let's explore what a stock split is. You have probably heard the term, especially with the big names like Apple and Tesla making headlines when they split their stocks. But what exactly is stock split? How does it affect shareholders? And why do companies do it? Let's find out. A stock split is when a company divides its existing shares into multiple new shares. For example, in a 2-for-1 split, if you owned one share worth of 100, after the split, you would own 2 share worth of 50 each. However, the total value of shares remain the same. Imagine having a pizza. If you slice it into smaller pieces, it doesn't increase the size of a pizza, just the number of slices. So let's break it down with an example. You own 100 shares of company X and the stock is trading at rupees 100 per share. If company X announced 2-for-1 stock split, you now own 200 shares, but the price adjusts to rupees 50 per share. The market value of holding is still 10,000. So why would a company do this? Great question, right? Companies split their stock for several reasons. First reason is affordability for investors. As the stock price rises over the time, it might become too expensive for the new or the small investor. So stock split makes it more affordable and accessible. Second is liquidity boost. So more share in the circulation can increase the trading volume and that making easier for investor to buy or sell the shares. Third, psychological benefit. So investors sometimes feel more inclined to buy shares at rupees 50 than rupees 100. So even though the underlying value hasn't changed. And number 4, that is marketability. So companies like Apple, Tesla have conducted stock split to maintain the price range that keeps their stock attractive in the market. Now, if you are an investor, you might wonder, what's in it for me? So, how does a stock split affect you as an investor? Here are a few key points. Number 1, no change in value. So your total investment value remains unchanged immediately after the stock split. If you own 10 shares at 100 each, you will now own 20 shares at rupees 50 each. Point number 2, increased ownership. If a company grows post split, the increased number of shares can lead to greater total value in the long run. And point number 3, tax implication. Generally, stock splits are not taxable event. However, if you sell your shares, that's when you might incur a tax on the gains. Well, while stock split doesn't directly increase the value of investment, it often creates positive sentiments in the market. So investor may view the split as a sign of a confidence in the company's growth potential, which could lead to stock price increase over time. However, remember that stock split doesn't always guarantee gains. Market forces and the company's performance still play a major role. So let's look at some notable stock split. Tesla. So in August 2020, Tesla executed a 5-for-1 stock split, which was aimed at making shares more affordable for the individual investor. Example 2, Amazon. So in March 2022, Amazon announced a 20-for-1 stock split, further enhancing its liquidity in the market. So this split often result in the increased trading volume and can lead to a positive movement for the stock. Now key takeaways. The stock split increase the number of shares but maintain the same total value. Point number 2, they make share more affordable and liquid. Point number 3, while stock split can create positive market sentiment, they don't guarantee an increase in the stock value. So in conclusion, stock splits are strategic corporate action that can have a various benefit for both companies and investor. So they make stocks more accessible and can potentially enhance market interest. So as always, understanding this concept can help you make informed investment decision. So there you have it. A stock split doesn't change the value of your investment but can make a stock more attractive to investor. So keep eye on the keep eye out for the announcement from the companies you are invested in. If you enjoyed this session, don't forget to like, subscribe and click the bell for the notification. Stay tuned for the part 4 where we will cover the next corporate action, merger and acquisitions. So stay tuned for the next part of our corporate action series. Thank you for watching.